Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, March 21st, 2018. In this video, I wanted to do a quick update on the broad markets. Also make mention, I mentioned this in the trading room yesterday, that I didn't expect much of anything to happen because we have the FOMC meeting today at 2 o'clock. Now, historically, the markets go into somewhat of a holding pattern. They trade in a pretty tight range leading up to that, either the day of and or the day before. So again, I didn't expect much fireworks yesterday, nor do I expect much today. And that's reflective in the charts, although there are some developments worth noting. And the important thing is, after an FOMC meeting, a couple things I've always made mention over the years. Be careful with your positions today. The market has a history of knee-jerk reactions following an FOMC meeting, meaning if you watch the 1-minute charts, which I always do, I always have a monitor up with a mosaic of, numerous streaming charts, including the indexes, everything else in stocks I'm following. And you tend to see a sharp spike up or down following the meeting, the announcement at 2 o'clock Eastern time. And that initial reaction is often then reversed, and then sometimes that reaction is reversed. So what I'm trying to say is you see high frequency trading, all these algorithmic trading programs, they fire off trades right away. And what I do is a couple things. Number one, don't react to that. There's a lot of takeaways I have for this. One example, if you're watching a stock, let's say you're looking at a long trade setup or a short trade setup, and it's that stock or ETF is poised to break out. Well, those knee-jerk reactions can very often cause a whipsaw signal because most stocks, especially if they're, members or components of an index like the S&P 500 or the small caps, mid caps, they're going to move in line from the forced buying and selling in that index. So that's number one. Uh, so I tend to be skeptical or extra selective on any breakouts that come in the wake of the FOMC meeting, what I call the post FOMC noise. That's what happens immediately after and really throughout today into the close. So, just be aware that any breakouts that occur, and then it goes just as well for the broad markets, could prove to be a false breakout. Um, and on the flip side, also that plays into stops. Let's say I have a trade and it's really close to its stop loss order. I may temporarily pull that stop loss order because you have a better chance of the stop getting clipped in the volatility with that spike, that stock or ETF spiking up or down, or futures, whatever you're trading. And then finally, if I have a trade that's very close to a price target, I may decide to just close it out early if it's, I'm profitable, it's about to hit my final target. Well, why risk, sudden reversal due to the FOMC noise? So that's just I wanted to share that. I think that's important. Be aware of market moving events such as FOMC meetings. Now, with that being said, here's what's supposed to happen today. Fed fund futures are priced in an over 90% probability we're going to get a quarter point hike. So that won't be a surprise to the market at all. It shouldn't be. And this Fed, unlike the Fed of yesteryear, actually many, many years back, does not surprise the market. We know that. So the odds of a 50 basis point rate hike or anything other than a quarter point rate hike, in my opinion, is slim to none. But it's all about what the Fed says afterwards. And that's why, again, that post FOMC noise can continue throughout the day and possibly later this week. All right, so that is what I do. Try to keep things light, a little extra selective on taking new breakouts just in front of a meeting, and then I may also give my stops a little wiggle room. But I also use that volatility if I am in a trade and it does have if I have a limit order set to fill at a profit target, I'll leave that in place. I welcome the volatility to take me out of a trade if it's profitable, but I'll also, on the flip side, I'm trying to avoid those stop rates. So hopefully that helps. That's just a little side tip there. How I've traded, lessons learned over the years, the expensive way. That's what I try to do here is, share my experience with the market. So we'll see what happens. Now, uh, I'll get into the charts here in a second. I've had quite a few requests on the site lately for updates on, for example, oil, gold, and GDX. I've shared some thoughts. Now, gold and GDX, and oil for that matter, those are dollar sensitive assets. gold very much, and to a pretty good extent oil. So what the Fed says today, what they do with their rate hike, and what more importantly what they say, how dovish or hawkish they are when they come out afterwards and give their statement, that is likely to have an impact on the U.S. dollar, which therefore can have an impact on directly indirectly on gold and oil. So also, like I said, I will wait to see what happens. I do have some thoughts. There's a lot of developments on the dollar. I've been covering that lately on the charts. And again, that'll be for members of the site. Commodities, particularly gold. That analysis is usually reserved for members of the right side of the chart. So I'll get you guys out a video on that later today and some static charts. And then finally, trade ideas. And that's what I want to talk on real quick before we go into the market analysis. That is where the money's to be made in the market. So far this year, here's January right here. You can see if I put a crosshair, first day of the year, here's where we're at right now. This is a 60-minute chart of the SPY. And so we go up here. January 2nd was the first trading day of the year. And where are we today? We're about exactly where we started. So we've gone nowhere. So what does this tell me? Buy and hold investors. You had a heck of a scare if they didn't shake you out there. You started to get excited to see your portfolio come back, but you're back to where you started. Now, I don't think there are some buy and hold investors here. And as I always say, I wear two hats. I'm an active trader, swing trading, sometimes day trading, but I also have long-term accounts, IRAs, 401ks, kids' college funds, all that good stuff. And so this is a trader's market, as I said, and I think it'll continue to be. So you can see those opportunities on the long and short side. And, just an example there, before we get into the charts on the video, look at the trades so far that we've had this year. We vastly outperformed the market. We were short Twitter. We shorted Twitter before it even broke down from this wedge. We closed that out for a 13% gain yesterday when that second target was hit. I made very clear my expectations for a bounce. So had you wanted to reverse the trade there for the bounce, you would have already been up, 6% or more. And Twitter will, as I believe, go back down. Now, I typically don't cover official trade ideas on the site. This is just sort of a general thing. Uppermost, we're probably going to come back up here to a little shy that first target area. And then I think there's more downside to come. Semiconductors, we were able to short the initial rip down. We nailed them right off the highs this year so far. Shorted right up here. Actually, that was on the daily time frame, and hit that first target where I made very clear I expected a bounce reaction there. So that's where the money's to be made. Overstock. We've shorted Overstock, traded it twice this year, both official trades on the site. The first trade, actually, I take that back. We had it last year as an official trade, very profitable, well into the double digits. And earlier this year, we closed it out right here at this when it hit the second and final target for a 44% gain. So again, the money to be made is trading individual stocks. A lot more profit potential. I could go on and on. We shorted the home builders. Hit the highs, shorted them off the highs, covered at the lows on the first drop down this year. And then we've had many trades on the long side profitable as well, commodities, even a broad market trade idea. And that's what I'll be focusing on this year. But as a trader, members of the site, I know some of you are not comfortable with trading individual stocks because of the increased risk and volatility. So I'm also making a point to incorporate more and more sector ETFs and index tracking ETFs into the official trade ideas on the site. So more on that later. Again, that'll be posted on the site for premium members later today. I'm sorry. All right, so now back to the markets. Here's what I think we're going to see here. I already made mention, a lot of noise, chop, but this is what I'm looking at. Here's the SPY 60-minute chart. Again, this is the world I've been living in a lot lately, the 60-minute chart. And I can just say this, it does not look good. This, to me, looks like a bearish pennant. This would be your flagpole, the impulsive move down to the pennant. And if that pennant breaks down, let's say the market doesn't like what the Fed says today, what they do or what they say, we're going to probably come down. You can see I have a support level there. Again, let's forget about these targets. They were already hit. This was the official trade. We already closed it out. We happened to, just get right out at the highs on that one. Like a lot of trades so far this year have reversed right when the final targets have hit. And so that's just looking at the charts, putting everything aside, what you think the market is going to do. To me, this looks pretty clear. I see an impulsive move down, followed by a period of consolidation, and that is typical. And if you're not familiar with this term, do a Google search on a bear flag or bearish pennant continuation patterns. They're both continuation patterns. So therefore, what I'll be looking for, um, and again, you might get some chop and slop here after the FOMC meeting today. But if you start to see us move impulsively down through below this period of consolidation, even if we get a little thrust up first, it doesn't go too high, then it's not going to be good. And I can tell you this, more and more the charts are looking like death to me, guys. I hate to say it. I know the majority of people. I know this from been running this site for many years, and even before that, an active trader, professional full-time trader in the blogosphere. I know the majority of traders are bullish and want to be told the market's going higher, but and maybe that's possible. I'm seeing increasing evidence that we are going to continue to go lower and may go on to take out these recent lows here. But again, you can't jump the gun. Let's see what happens. The charts are dynamic, and so is my analysis. So if we start to go up, you can see I made mention the other day, we have a gap right here. Let me highlight these levels for you. Um, so if the SPY wants to kick back and it likes what the Fed says today, or for whatever reason, here's a gap to watch. There's a pretty big gap from the other week right here. Let's see what happens, how SPY treats that gap. Gaps act as resistance when tested from below. So you either have the bottom of the gap or the top of the gap. And as of now, that's my uppermost bounce target. Trend indicators are still bearish on the 60-minute chart. Again, there's a lot of downside potential should this pattern play out. And then when you look at the Qs now, remember the Qs, although not as diversified as the S&P 500, that's been the leading index, meaning it holds more of the beloved FANG stocks, Facebook, Amazon, Alphabet, Microsoft, all those companies. And this to me also looks, in this case, it's more of a bear flag pattern more than a bearish pennant. You can see, oh, you can take the form of a pennant. You don't have to split hairs. A flag just looks like this. Flag goes up that way, whereas the pennant, as the name implies, is more of a triangle shape like a pennant. Either way, what you have are the appearance of it and everything that you look for. Number one, the first part of a bearish continuation pattern is an impulsive move down. Impulsive means quick selling. You had a gap there, although there's no candles. Think of that as big red candles because that was a move down. In fact, it's even more bearish than a red candle because you gap down below. So that's the impulsive move down. This is the flagging action or pennant action, however you want to look at it. And so later this week, if the market doesn't like what the Fed says, or for whatever reason, forget about the Fed, the market will do what the market will do. That would project down, and it might even, could even undercut my 163 target that I've been highlighting recently. There's a reaction low right there. And at that point, probably get a kickback rally. But again, trend indicators that I use on the 60-minute time frame are clearly bearish right now. So I'm having a hard time getting bullish and looking for another new high, at least at this point in time. Finally, let's just wrap this video up quick with the outlook for the market leading stocks. I have a watch list over here. These are all the components of QQQ. They're sorted in order, descending order of market cap. Apple being a $890 billion company. So let's look at Apple. I know a lot of folks love this stock. A lot of folks own this stock. But this chart does not look good to me. In fact, this may become an official trade idea on the site. Although I'll tell you this, guys, let me just say this. Because of all the indexing in recent years, and I've talked, for quite a while about this, and in fact, I dubbed a term called the FANG Stocks, FAAMG, back over a year ago, and it used to be everyone talked about the FANG stocks, FANG. Now it's Facebook, Amazon or Facebook, Apple, Netflix, and Alphabet, which is a Google. But these are the big ones that make up the bulk of the returns of the index, and I call them the FANG stocks, FAAMG. And what I'm getting at here, guys, is there's so much index. We've had an unprecedented trend of indexing in recent years. And so what happens is people start pulling money out of the market. They pull it out of SPY, they pull it out of QQQ and those index tracking funds, and they come under forced selling because these are the largest components. These make up the bulk of or a good percentage of the Nasdaq 100. So great companies or not, is Amazon going away? Or none of these companies are going away, but no matter how rosy their earnings are and their outlook and all that, they're going to get dragged down with forced selling, just as they got pushed up to extremes from forced buying as money flowed into the market and people wanted to buy stocks. It's as simple as that. So therefore, you can short Apple or you can short QQQ and get, the same net effect. You may outperform, and in my opinion, and personally, I like to sniff out the most bearish stocks within a sector or an index and short those. Or when I'm bullish on the index, I'll sniff out the most bullish stocks. Same with a sector, and usually outperform that index by a good margin because you can have the good and the bad. When you go long or short an index ETF, you're shorting or going long both the most bullish and the most bearish stocks. So you're diluting your returns, but again, you're mitigating your risk. So there's pros and cons to each. Here it is. Let me just go through the charts because if we can determine where these top ones are going, I won't go through them all, then we know where the market's going. I talked about Apple for a while here. I pointed out here, I warned of a correction in Apple back here before this wedge broke that was posted on the site. Played out. You can see we hit this target. We did get the correction I was looking for, and we bounced back like the markets did. And, I was expecting a bounce in the market, and Apple posted that as well once we, had that initial thrust down. But look how perfect the technicals work. And this is my experience is that they always work well during periods of increased volatility because that's when market participants, even the big boys on Wall Street, fund managers, they fundamentals kind of take a back seat when everything's moving fast. That's when technical analysis, everybody flocks to that. Okay, where do I need to cut my losses on Apple? Where do I need to exit if there's a bounce back? Let's say you've determined the market's most likely headed to a correction. So this is where they go. They don't look at Apple's outlook for the next 18 to 24 months as far as fundamentals, at least not in timing entries and exits. That's where technical analysis comes in. And that's my theory, at least, as to why it works so well in periods of market volatility. But if you're to get back to the point I was talking about here. So what happens? This is the rising wedge, the divergent high pointed out here, pointed out after it broke down. That's the initial correction, which is roughly in line with the wedge measurement. You take the widest part of the wedge, you add it to where the wedge broke down, and we had a kickback rally. Back test number one, a little pullback, back test number two. So we back tested the wedge. And with bearish rising wedge patterns, usually one of two things happen. When they break down, that's either it. They break down and a correction ensues, new trend change, or you break down, as you did here, and you back test the wedge followed by another thrust down. And that's all we've done so far. We've had a back test of the wedge. And not only that, I didn't put the DH here. DH means divergent high. I showed you all these divergent highs in the past. Correct 12% correction, 9%, 10%. This one was even bigger. I haven't labeled it yet, but you can add divergent high right here because prices made a new high on that back test. So now we have even more powerful divergent highs on the world's most beloved stock right there. And this indicates, as I always say, corrections on stocks are typically commensurate with the scope of the patterns and the divergences. This would indicate to me much more downside to come in Apple. And if you want to target right there, I'd be looking at this level. And ultimately, there's a big thin zone down here. Let's not get ahead of ourselves right now. Let's just say right now, the mid, about 142 or so is where this one, if this does play out, unless they can somehow foil the bearish technicals that are in place now, I think that's where Apple's headed in the coming months. Alphabet looks a little better. This is Alphabet or GOOG, and you have a almost an equal high, so didn't make a new high. We did have a divergent high here, but about a roughly equal high. If you don't want to split hairs, you say it was an equal high, and then you call that even a second divergent high right there. Still above trend. And again, not this isn't one of the first ones that I would short. I would rather short Apple before Alphabet. That's just me. I think there's more downside to come. But then again, here's a trend line you can see, and we're not very far above trend right now. So a lot of these stocks are in precarious technical positions. Here's Amazon, great company, but getting up there. Here's the P ratio right there, 251. And again, it's not about how strong the company is doing. When you get forced selling, when you have a big move in the market or big rally, the whole baby gets thrown out with the bathwater thing. Amazon will be dragged down. If I give you my word, if QQQ drops 20%, if the Nasdaq 100 drops 20%, it would be virtually let's say it would be extremely unlikely that Amazon does not drop. It will probably drop. It may not drop 20% in line with the index. It could do more, but that's just the nature of the beast here. Unfortunately, the same forces that drove it up. Of course, it had its own fundamental story. Don't get me wrong there, but it was a lot of sympathy buying, force buying from QQQ. But there's a little bearish rising wedge pattern. So this one's coming back in. I have no doubt about that if the market corrects. Microsoft, same story. And I'll wrap it. I'll hit two more, Facebook and Intel after this. There it is. You had a divergent high right there. It's not labeled, but right at this point, you can see the negative divergence down here on the indicators. And we had a correction that measured. I'm just going to go to the right of it here, get about the same level, and tell you that that first divergent high resulted in a drop of about 12%. 12.5% Microsoft. This is a second consecutive divergent high. It's, although it's its own divergent high, it's really simply an extension, meaning more powerful divergence that started back here. In fact, the divergence is steepening because you have this consecutive divergence. So what do I see? What I think will happen because of this? This isn't going to lead to another, 5, 6, 7% drop. We're so close to the trend line that, in my opinion, this trend line and this alternative magenta trend line here, they're both probably going to break, and Microsoft will see 79, 67 or so, probably in the next few weeks to few months here is my guess. And again, unless these chart patterns are foiled. By foiled, what do I mean by that? Well, we have to take out the divergences that are in place right now. That's one thing, and that would be, the stock would reverse and move higher. I don't see it happening, guys. Like I say, I'm becoming increasingly bearish on this market, um, and have been for a while. We could see the top coming, but I just thought back in that correction that we had late January to early February, that wasn't the time to. We were short that, let me make clear, but I figured we'd get that one last bounce higher, and that's what we did. And there it is. Here's Facebook, big component. And again, technical analysis is just working well. This isn't a trend line that I've added after the fact. This trend line was here beforehand, this divergent high, this rising wedge. And this is technical analysis where you had a divergent high, the stock dropped. I'll measure it out in a second for you. Had a kickback rally. We were back testing that trend line or the wedge from beneath for a while, and then boom, an impulsive move down right to that support line. Again, these lines were here in advance. I, had this line back here. Might have modified it. Let's see. Yes, this one was modified. I had a support line right here, and I added this one here. It caught this reaction low, and that is support. So as long as that support holds, good. But this I added back here a while ago. Created back in April of 2017, I guess, unless I moved that around. Yeah, I must have moved that line around. What I was talking about here is on this divergent high, when I went over this chart most recently, I was pointing out all these divergent highs right here, 10% drop, 16% drop, 3% drop on a small divergent high, 6% drop, big divergent high, and this is the drop that I think before all is said and done will happen, and it's going to play out something like this. Maybe a little kickback rally, but if we break down soon, boom, we hit that level. And so if you're bullish, you don't like the short stocks, I get it. If you're looking to go long and the charts confirm at the time, look for 145 on Facebook. That might be a good entry. And finally, the last one, I Also use an acronym I call the FANG stocks. It's hard to pronounce that. FAAMGI, because Intel is the sixth largest component, or at least was, when I started that term. Here it is, big. Look at this, this steep uptrend line, sharp divergences. You can see the negative divergence, and again, it's the same story as the other ones. We had divergent high number one right here, correction number one. See the divergence mark down here? That was the first divergent high. We kicked back up, made new highs, similar to my scenario with the market going to new highs, which QQQ did, and we did so by putting in an even larger divergent high. So we started to crack below this trend line recently, but the market's holding up. So Intel, that's my path for Intel right there. Probably come down at very least to retest that $43 level again. And I know some of you will hate to hear it, but I think before all is said and done, sometime in 2018, maybe sooner, maybe later, Intel is going to probably come back into this 38.50-ish level. And there'll be some great buying ops if I'm correct here, and this market's going lower. So don't, if you are a long side only trader, you don't have to short the market. You can take some hedges. I've done some videos on that recently on how to hedge fairly conservatively, hedge a portfolio longs. But I'll make a point to, let you know when I think it's time to get, safe to get back in the water if you're already out, or maybe you're long. You realize you had that shot across the bow in January to the early February correction, and you're saying, "Ooh, okay, this market is getting a little shaky now." So you've at this point, and I think it would be prudent if you're long a lot of these stocks to maybe just raise your stops at this point to protect profits. If you've held Intel for months or years, um, maybe I'll prove to be right, maybe not, but I can tell you right now, okay, let's just keep it simple on this. And this is one of many examples. There's a good level, 47.75. That is a pretty well-defined support level. And if the stock breaks that, especially very impulsively on a closing basis, if I were long Intel, if I had been long this stock for, months or years, that's where, and I was bullish looking for new highs again. This is where my stop would be, just below that level. I'd give it a little room if it broke down here, but if it takes that out, like I said, this is the next stop down here. Maybe backfill that gap down there, and then ultimately, after a reaction off that level, might work its way down here. So long video. I wanted to cover everything. Again, the takeaway is the charts look increasingly bearish. Maybe we get some developments here in the next coming week or two that change my outlook. But as of now, um, and there's other things I haven't even covered in this video, market breadth, sentiment. That's another thing. I just read an article in the journal the other day that despite that big swoon down in January, bullish sentiment, although it did back off extremes, it was already at record highs. And I had covered that before that, even shortly before that correction, how sentiment was at extreme highs, dangerous levels. And the gist of the article was it didn't really shake confidence that much in the investors. The polls say, I think it's like 60 something percent or over of people polled think the market's going to go on, continue to chug on to new highs. So if you don't know what I'm talking about, that's a contrarian indicator. When you have the vast majority of people, when you have sentiment at bullish or at bearish extremes, that's when you want to pay attention to those because they work to serve as contrarian indicators. And I just wanted to point that out. So I think this market's going to it's going to take another big leg down to really knock down that bullish sentiment, and which is a healthy thing longer term. So maybe we do get another big thrust down, hit some of these targets I'm talking about, and then go on to make new highs in 2018. That's certainly a possibility. So right now, I'm not all doom and gloom saying that the bull market is over. It could be, but it very well may not be. We just don't have anything remotely close to long-term sell signals yet. But I know I've gone on and on this video, but just wrap it up here. These are the important trend lines I'm watching. It's not a be all end all. It is important, very significant technical levels, but you can see the SPY is flirting with uptrend line support off the 2016 lows, with QQQ flirting with, or not flirting here yet, a little room to spare. Q's bottomed in with that little flash crash back in mid 2016, but I also like to look at NDX because NDX didn't on that flash crash. It didn't go down as much because this was the actual index. QQQ is an ETF, so there was a disconnect between the drop on QQQ and NDX in the mid 2015 meltdown. But so this is a alternative trend line, but it doesn't matter. 6 to 1 half dozen to the other, because if you take QQQ, that candle was just a little longer. The candle went down like this, and so that trend line, it's the same trend line. That's what I'm trying to say. And just in case you're wondering why my QQQ trend line comes off mid 2015, but yet the Nasdaq 100 comes off early 2016, just like the SPY. Bottom line, these when both of these go, the Nasdaq 100 and the S&P 500, they go on a weekly closing basis. That is going to be quite bearish. Maybe they break down and back test, but this is a trend that has now defined the current uptrend for what going on better than 2 years now. So that will be a very technically significant event if and when we get those. And the analysis I just covered on the 60-minute chart tells me that could happen very soon. It could happen after today's FOMC meeting. It could happen in the next week or so, or maybe the Nasdaq 100 comes here and tests this and makes new highs. But right now, I'm leaning towards a breakdown of these trend lines soon here, so be careful, guys. A little bit of divergence there too on the Nasdaq 100 when I look at the weekly chart. So, all right, hope this helps. And again, I'll follow up with some more official trade ideas on the site, as well as updates to our existing trades. I'll touch on oil, gold, and whatever else. If you have a chart request, just drop me a line in the trading room. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.